So here we go with the basic concepts, and the first one is what is a business? Because we are concerned with the accounting process of a business. So first we need to understand that what can be termed as a business. So here I would also like to make it clear that for any organization to be called an organization, it must have three things. It must have a structure. It must have some resources. It may be tangible resources, or those resources might be, human resources. Lastly, it must have a goal or a purpose. And if that goal is of profit making, that means selling some goods or services and in return getting revenue and earning profit, then only those sort of organizations can be termed as business. Why? Because there are organizations that have structure, that have resources, but their goal is not profit making. They might be working for some charitable purposes. So, such sort of organizations are not termed as business. But on the other hand, those are termed as NGOs, non governmental organizations or charity organizations. So, this is the very first thing that we need to make clear. Now, the next thing is that businesses have some types and have some forms. You can look over here. In types, we have three broad categories. There are businesses which are manufacturing some goods, some tangible nature items. They are manufacturing them in some factories and are, selling them to retailers. Ultimately, it reaches to customers. But the manufacturing of goods is again a separate sort of a business. Then there is a business termed to be trading business, in which the manufactured goods are taken from the manufacturing site and are delivered to retailers and ultimately to customers. So there is a whole distribution channel involved, from manufacturer to wholesalers to retailers and ultimately customers. So that sort of business is termed to be, trading business, which doesn't, in fact, actually manufactures the goods from the raw form to the finished form, but in short, they just, take the ready-made goods and deliver it to the end customers. Such trading sort of businesses also include the import and export businesses. So these two basically are the categories which are related to tangible nature items, which we call goods. The last category is service businesses. Service businesses are the businesses which don't basically give you the tangible nature items, but on the other hand, they give you some services. Like we have banks, we have insurance companies, we have educational institutes, and we have hospitals, etc. So these are basically the examples of some businesses which provide you services, and in return, they charge you some fee or some amount, which is their revenue. On this side, you can see we have some forms of businesses. There are three broad forms of the businesses, though there are many other hybrid forms as well. But for understanding, we'll only take these basic three forms. The first category is the sole proprietorship, or which we call the single owner business, in which one person basically starts the business and runs it. He basically manage and control it himself. He may have some workers for his help, but all the management is basically done by that single owner. The second category is the partnership, which from the name is pretty much clear that there are two or more than two people who basically invest the money and manage the business together. So in this sort of business, again, because there are more than two owners, they are collectively making an effort to manage the business, and they are, they'll share the profit, which is, gained by the business. The third category is the company, or we may call it corporation. It consists of many owners, which we call shareholders, and who invest the money in the business. But in here, the shareholders don't basically manage the business. The management is done by managers, which are appointed by the board of directors, or basically the owners of the business. So, in short, the owner of the sole proprietorship is termed to be proprietor, while the owners of the partnership are termed as partners, and in the company, the owners are termed as shareholders. So here we go with the five basic elements of accounting that we need to basically understand in order to do the accounting process in the later, subsequent videos as well. We'll study the five basic elements: assets, liabilities, capital, revenue, and expenses, and we'll look at the examples of all these one by one. The first is assets. all the things, all the properties, all those possessions which are owned or controlled by any entity, be it a person, be it an organization or a business, are termed as assets. And these are basically kept for some to get some future economic benefit. So assets are basically held with the intention to get some future economic benefit, be that benefit in cash form or in a non-cash form. But assets are there to give you some benefit in future. Assets are broadly categorized into two categories. The first category is assets can be tangible or intangible, and assets can also be short term or long term, which we call in accounting terms or in business terms current assets and non current assets. So I'll give you some examples of all these assets and the further categories one by one. The first is the tangible and intangible assets. By tangible, we mean the physical assets of a company, which include the machines, equipment, building, land, their vehicles, etc. And by intangible, we mean the non-physical items, which we may not be able to touch or see, but they are there to give some future benefit to the business. And this includes some copyrights, patents. Business may have some registered brand names or logos. So all these are examples of intangibles, but they are there to give some future economic benefit to the business. Then we have current and non-current asset. Current asset means short-term assets, and non-current means long-term assets. Why, uh, by this, categorization, we basically mean that the short-term assets basically benefit the business up until only 12 months or up until a year only. So this include the cash, receivables, inventories, or maybe the bank balance or short-term investments, because these all are the items which are very short-term and give the benefit for a maximum of 12 months. Non-current assets are also known as fixed assets or long-term assets, which include all those items, all those properties, which give us the benefit in for more than a year, let's say 5 year or 10 year or even more. This include the land, building, your vehicles, and all the machines, equipment, or furniture. All these are basically example which of the assets which give you benefit for, let's say, 2 years, 5 years, or even more. The second element is liability or liabilities. These are basically the debt obligations of a business. For instance, if a business takes loan or is taking something on credit, it is generating this liability because in return they have to pay them back in future time. Examples are the bank loans, the payables. That means you have taken some material or supplies from a supplier and you haven't made the payment yet. So that will be termed as your payables. We have accruals as well as liability, because accruals are all those expenses which you haven't paid yet. For instance, you haven't paid your bills or the amount of rent. So that would be termed as accruals or accrued expenses. So these are basically your obligations which you need to fulfill in the future time. That's why we are calling them your liability. So business may incur some liabilities. Liabilities again are divided into current liability and non-current liability. Again, by current we mean short-term liability, which you must fulfill or you must pay off within 1 year. And non-current liability means the long-term liabilities, long-term debt obligations. For instance, you may have taken loan for 5 years from a bank, or you may have taken some vehicle on installment from a bank, which you need to pay off in 5 year, 10 years, or even more time. So that would be the example of your long-term liability or non-current liability. Moving on, we have the third element, which is capital. Capital is basically the fund or money invested by the owner, or you maybe the owners of a business, depending upon the form of the business, which we basically studied a while ago, because there are three forms: the single owner, partnership, or the corporation. So depending upon the form of the business, whatever the amount is which is invested by maybe a single person or multiple owners, we call it capital, and it is also known as owner's equity. Do remember here that a business is started with some money, with some funds invested by the owners who have taken initiative to start the business. But in the the in the life of the business, they may need some additional funding which they may acquire through liabilities or from bank loans. So these two form your basic sources of funding as well. The liabilities and the capital together, they form the two basic sources of your funding, and this funding is required to basically purchase or get your assets. The fourth element is the revenue, which is the money or proceeds that you get in return from selling some goods or rendering the services. The amount that that your customers pays you is basically your revenue. Lastly, we have expenses, which are basically the costs incurred to generate the revenue. Well, examples of expenses can be, anything which you have spent for, giving wages or salaries to your employees, the utility bills like water, gas, electricity, telephone charges, and, you may have spent some money on advertisement of the company, or administrative charges might be there, stationery, etc. So all these basically are the examples of your outflows or your money that you have, spent to keep your business operational. And these are basically there on a recurring basis. That means you need to pay them again and again, maybe on a monthly basis or maybe on a semi-annual basis, but these must be paid regularly in order to keep your business operational. So now let's sum it up with the help of this example over here. Suppose there is a group of students in a university or in a college who have decided to, basically install or basically start a small business, or they are starting, to raise some funds. They are starting to invest their money to start a stall, which is for French fries, for selling the French fries. So they need some money. First of all, they need some money. They may invest the money by themselves out of their pocket, and they may get some additional funding by taking some loan or taking some money from others as well. So the money they have spent themselves out of their pocket can be termed as capital, while the money that they may take from others, which with the intention to pay it off later, would be the liability. With this money, they will acquire or they will buy some basic equipment, the stall, and maybe the basic, items like to set up their stall. So all those things can be their assets. Like all those resources that they need to start up this stall would be their assets. So up until now, we have basically covered three elements: the money invested by them. First of all, the money may came from their pocket, that is capital. They may have taken it from others, that is liability. Using these two sources of funds, they have purchased the stall, the space for setting up the stall, the basic equipment for this, to work with this, business. They purchased that equipment. So all that sort of resources would be their assets. Now they need to incur some additional expenses or costs which are recurring in nature in order to manufacture the ultimate good, which is French fries. For that, they need some raw material in terms of, you may call it, they need potatoes, or they may need frying oil, or, more of such items or packaging material. They may also need they need to incur some, utility expenses, like they need electricity, they may need water, gas, or other supplies. So all those costs which they'll incur on utilities would be termed as their expenses. Ultimately, when they manufacture their ultimate product and they sell it to, other students in the university or their college, they may generate some income, or they may get money from all the customers. That would be their revenue. So here I would also like to, clear this, confusion that some might confuse it, that revenue is your profit. Revenue is not yet your profit. In order to get your profit or calculate your profit, basically the revenue which is generated by selling some goods or services, basically you subtract all your expensive expenses from that revenue to get to know whether you are in profit or loss. So subtracting expenses from revenue either ends up or results in profit if revenue is greater than expense, It might result in loss if your expenses are higher or more compared to your revenue. So, in this particular lecture, we have covered five elements: assets, liabilities, capital, revenue, and expenses. And through this example, I sort of try to elaborate that how this basically works with an actual business as well. So it's basically an example of a small scale sort of a business. But again, same is the case with the large businesses. They have their own assets, their equipment, land, building, machinery. They have their own, they might have generated funds through capital. That means money taken from shareholders or owners. They might have taken money or funding from banks, and they need to incur some expenses to generate the revenue. To basically generate the revenue, they need to incur some expenses. So ultimately, they have their own profit or loss situation as well. In the subsequent video, we'll study more of the accounting concepts like purchase and sales, their types, the cash and credit purchase, cash and credit sales. We also will also look at the debtor and creditor, like receivables and payables. Then we'll cover the accounting equation and the related calculations. And lastly, we'll look at the rules for debit and credit, which will help us to basically start off with our first stage of accounting process or accounting cycle, which we call recording or journalizing. So that's it for now. Thank you.